Enbridge falls under the energy sector of the stock market, which many investors are completely avoiding nowadays because of fear. In my opinion, this is a huge mistake. Not all energy companies are created equal. And as history teaches us, when there's fear, there's always opportunity. So in this video, I want to share with you guys the 4 main reasons why I love Enbridge so much. And we'll also look at 2 announcements Enbridge made recently, which further proves that this is a great long-term investment. And of course, I will also show you how you could get a 13.5% dividend yield by investing in this company. That's right, you heard right, 13.5%. I would love for everyone watching this video to join me and really build your own pipeline of cold hard cash straight to the bank. So Enbridge is the 3rd biggest dividend paying corporation in Canada after Royal Bank and TD Bank. It's also the biggest energy company in Canada that moves 25% of the oil and 20% of the natural gas produced in North America. It also operates North America's 3rd biggest natural gas utility. And when you think utility, you should always think of electricity, which is pretty much the backbone of our entire existence right now. So I will quickly go over the 4 reasons why I love Enbridge, and I won't be talking about numbers here like balance sheet analysis, profits this year versus last year, and other stuff like that. I will simply use good old-fashioned logic that everyone should be able to understand, because logic is really all you need if you're a long-term buy and hold a dividend investor like myself. Reason number 1, Enbridge is an energy infrastructure company, not an oil and gas producer. Very important difference in the energy space. So companies like Suncor, Husky Energy, Vermillion Energy, or even Shell have all had a horrible year in 2020 because their profits are tied to one thing and one thing only: commodity prices. So all of them have slashed their dividends this year because of the steep decline in oil prices. Enbridge does not have that problem. They are simply the middleman. That's why they are considered, or they're called, a midstream company. They manage the infrastructure to deliver these precious resources from the producers to the utility companies to generate the electricity that we all use. So from an investor point of view, this is a very important difference because this fact makes the stock much more stable, unlike oil and gas producers. So this is why midstream companies like Enbridge, TC Energy, and Pembina Pipeline are included in ETFs that focus on utilities. They are a critical component of electricity production. Reason number 2 is that Enbridge is huge. I'm talking about market cap here, so really what the company is worth. So today, their market cap is just under $86 billion. And a market cap, if you're wondering, is simply the number of outstanding shares multiplied by the stock price. So like I said earlier, it's the biggest energy company in Canada, and by a lot. So just to give you some perspective here, TC Energy, which is also a Canadian midstream energy company, is the 2nd biggest in Canada, and it's valued at $53 billion. So big difference. So bigger is better when it comes to companies or stocks, in my opinion. The bigger they are, the more capital they have access to, the more power and influence that they have, and they also attract a very high level of talent. Reason number 3, Enbridge is a Dividend Aristocrat. Not an easy title to get. So to get that title, a company needs to have a long history of constantly raising its dividend every single year. So aristocrat is probably an understatement for Enbridge, in my opinion. I would say that they're really kings in this regard and really in a league of their own. Enbridge has raised its dividend every year for 25 years in a row, and that's very impressive. We'll make that 26 years because this year is no different. On December 8th, just a few weeks ago, they announced another dividend increase of 3% from $3.24 a share to $3.34 a share. So this is the first announcement I wanted to share with you guys, which is very, very positive. If you're wondering how the heck they managed to do this, which is probably one of the worst years ever for energy companies, my answer would be, don't forget reason number 1. Enbridge is an energy midstream company or an infrastructure company, not an oil and gas producer. So their cash flow or profits is much less affected when there are big swings in commodity prices. All right, so reason number 4, and in my opinion, this is the most important one if you're a long-term investor like myself. They are big on ESG, so environmental, social, and governance. So this is extremely important, especially for the future. The fact that they have a plan to become more and more green in terms of the environment is a great sign for investors who think long term. It just proves that they have good management. Management that is planning for the future and planning the gradual shift to greener energy. Something that is much easier to do, of course, if you're big and have a lot of money. So this brings me to the second announcement I wanted to share with you guys. On November 6th this year, Enbridge released a statement which outlines a blueprint for the future in terms of their ESG. So I'll give you the headlines, but you can always read the whole announcement yourself on their website. I'll put the link to that in the video description. So their three main points are the following. A new goal to achieve net zero greenhouse gas emissions by 2050 with an interim target to reduce greenhouse gas emissions intensity 35% by 2030. Number two, increase representation of diverse groups within our workforce by 2025, along with new actions to enhance supplier diversity. And point number three, further strengthening a board diversity with an increased goal of 40% representation of women and a new goal of 20% of racial and ethnic groups by 2025. So there you go. So not only are they planning for the future in terms of shifting to green energy, but they're also committed to a more diverse workforce and a more diverse board of directors. So all positive news for investors who think long term and take ESG seriously, which is becoming more and more important, especially for younger investors. So another thing I wanted to point out to you is that Enbridge does not only own pipelines right now. They are investing and have already invested more and more in renewable energy. So they own and operate 22 wind farms around the world and are also investing in solar power. So I bet you didn't know that about Enbridge. Once again, this shows me that they are really transitioning for the future. Okay, so how do you get a 13.5% dividend yield by investing in Enbridge? Even with the recent dividend increase, the dividend yield is 7.92% as of December 17th. Still a great dividend yield, don't get me wrong, but 13.5 sounds much better, right? Well, you get it by investing in the E-Split Corporation, which is a split corporation. The stock symbol is ENS, and the fund invests in only one company, Enbridge. So how does it manage to generate such an enormous yield? So although I covered split funds in detail in another video, I'll summarize it quickly for you now. But if ever you're still confused, check out my other video where I explained it in detail. The link should be flashing on your screen right now. So split share funds or a split share corporation are specifically designed to maximize income from a basket of dividend paying stocks, or in this case, one stock, Enbridge. So it's called a split because there are two classes of shares with their own stock symbols. There's the preferred shares, which are listed under the stock symbol ENS.PR.A, and then there's the Class A shares, which are listed under the stock symbol ENS. Now, the preferred shares are completely useless in my opinion because the dividend yield is about 5% on them, which is even less than owning Enbridge shares directly. The Class A shares, however, so ENS is where all the magic happens. ENS is basically leveraged exposure to Enbridge shares. Leverage is borrowed money the fund manager uses to amplify the dividend yield. On top of that, the fund manager uses covered calls to generate additional income. So in short, the Class A shares, which are the ones we're interested in here, are really funded by three things. Capital appreciation on the Enbridge shares, capital gains that the fund manager makes, and the option premiums from selling those covered calls, all three of which are amplified by the leverage. So how safe is this type of fund? Well, in my opinion, very safe. It's actually the strongest split share fund I have ever come across for really three main reasons. Number one, they never missed a dividend payment. Number two, the NAV is very strong, or the net asset value. And number three, as far as I know, it's one of the only split corporations that actually raise their dividend. Normally, the dividend for a split corporation is really set in stone. So this is also impressive. The easiest way to really think about a split corporation is that it's basically almost the same as a covered call ETF. The only difference is that it uses the leverage. So you have an amplified dividend. So basically it's a covered call ETF on steroids. That's the most simple way to look at it. It's specifically designed for investors that love the companies inside the fund. They're happy to own them for a long time and they want to suck out as much income as they can while holding it. It's as simple as that. So let's quickly check out the fund's homepage so you could put all this information together. So here's the homepage of the eSplit Corporation Fund. So as you can see on the homepage, it literally says enhanced participation in Enbridge. Of course, this fund is managed by Middlefield Funds, a really solid asset manager in Canada. If you click on fact sheet, you will see all the details you need to know about this fund, the stock symbols, the eligibility. So obviously you could put it in RSP, TFSA, everywhere. The management fee is 0.75%. Well worth it in my opinion, simply because it takes more work from these guys managing it. Don't forget they sell covered calls every month on this fund. And here's the reasoning behind investing only in Enbridge for this fund. As you could see, 25 years of consecutive dividend increases. Of course, it's 26 years now, so really solid. If we go back and click on NAV, which stands for net asset value, you can see that the net asset value for the Class A share, so basically ENS, is $10.86. Preferred is $10.11. So if you add both of them together, you will get the unit NAV, which is just under $21. So very strong NAV for a split fund. And here you have the dividend history. So if we go in 2018, it was 10 cents. That's when the fund was created. But in 2019, starting with the June 2019 dividend, they increased it from 10 cents a month to 13 cents a month. So a really huge 30% dividend increase. And you could see the announcement here where they actually announced the dividend increase for ENS. So they say the distribution increase is supported by dividend growth from Enbridge as well as income derived from a covered call strategy. So really good news. You could see that they're pretty happy, these guys, with that. And who's to say they won't increase it in the future? I mean, Enbridge, if they keep increasing their dividend, that means the eSplit Corp will probably one day soon in the future also increase their dividend again. So this is just great for long-term buy and hold investors like ourselves. So there you have it, guys. Enbridge should definitely be a stock in your dividend portfolio, in my opinion. It's still very undervalued right now. A great time to pick it up. Its 1 year high was $57, and right now it's trading at $42. So a nice discount, and a similar story with ENS, since ENS really follows what the share price of Enbridge is doing. So investing in ENS is simply an efficient way to maximize your income by owning a small piece of this great company. And the dividends are given out monthly instead of quarterly, which is what the regular Enbridge shares give. So there's another cool advantage for you in terms of ENS. I strongly suggest you invest in ENS, guys. I promise you won't be disappointed. And if ever you're hesitant about ENS or a split corporation in general, I strongly suggest you check out my videos on split share funds and also the homepage or the website of the eSplit Corporation to learn more about them. And if you're still not convinced after that, well, at least invest in the Enbridge shares directly. So please hit that like button if you learned something from this video, guys. I would really appreciate it. And if you like high income investing ideas, please make sure you're subscribed to my channel, because this is what the channel is all about. It's really getting that high and easy passive income. Also, make sure to follow us on Instagram, just another way to be alerted of our new content and more. So my mission remains the same, guys, to help everyday working Canadians to invest on their own and build their own stream of passive income to enhance their quality of life. So as always, thanks for watching. Happy holidays, guys. Make sure you stay safe, and see you next time.